Okay, before we get started, let me show you how to upload your assignment. Well, now let's see. I believe all of you can see my web page, right? Here is the Blackboard site. You log in and you find accounting, managerial accounting class. This. Okay. Now you go to assignment. Here, right here. You go to assignment. Here you can find this assignment, second midterm upload. You click in. Cancel. You click in this link. And okay, right here. This is where you upload your submission. When you finish your cheat sheets, you can scan them or simply take a picture using your smartphone. And here is where you upload your submission. You find your files, for example, this one. You click open. And now this file is listed right here. And finally, you click submit. This is how you upload your second exam cheat sheets. Any questions? Okay, so let's continue on where we left in the last class. Oh, well, front and back count as one page. Just one side is counts as one page. Two-sided, 2 pages. Okay, let's continue on where we left. Well, in the last two classes, I introduced how to prepare the master budget for the manufacturing companies. Well, today I'm going to introduce how to prepare the budgets for merchandising companies. Okay, merchandising companies. This slide shows the structure of the master budgets for merchandising companies. And again, what is the difference between merchandising companies and manufacturing companies? Well, the only difference is that manufacturing companies make products on their own, while merchandising companies do not manufacture products. So as you can see, the only difference for the budget structure is here. Here, the parts listed in blue words is the difference. For merchandising companies, this part is inventory purchase and cost of goods sold. And do you remember what is this part like for manufacturing companies? Well, very good. For manufacturing companies, this part is the cost, including direct material, direct labor, and manufacturing overhead. So again, merchandising companies purchase the products they sell rather than manufacture them. Therefore, the master budget for a merchandising company will be slightly different from the master budget for a manufacturing company. The inventory, purchase, and cost of goods sold replaces the production budget, direct material budget, and direct labor budget, as well as the manufacturing overhead budget. Okay, in this part, let's use another company as an example. That is Greg's Games. Greg's Game is a retail chain store that carries a complete line of video and board games. We will prepare the master budget for one of the retail stores for the month April, May, June, and July. Okay, now let's imagine it is the end of March. Now, this is the end of March. So here we have the balance sheet as of March 31st. We will make the budget for the following 4 months: April, May, June, and July. This balance sheet provides some of the data that we use in preparing the future master budget. Well, this is the sales budget. Similarly, in a merchandising company, just as in manufacturing company, the forecast of sales revenue is the cornerstone of the master budget because the level of sales affect expenses and almost all other elements of master budget. Budgeted total sales for each product equal the sales price multiplied by the expected numbers of units sold. Okay. This slide shows the expected number of goods sold for April, May, June, and July. Well, all of these numbers are budgeted numbers. In other words, are expected numbers. But before that, I would like to give you the information in March. Well, in March, the actual total sales is accounted for $40,000. Among this $40,000, 40% is on cash, and 60% is on cash, and 40% is on account. And this company collects all the sales on account the month after sale. So in other words, 60% of the sales in March is collected in March, and another 40%, that is 16,000, will be collected in April. Well, this is 40% of $40,000. That is 16,000 will be collected in March, and in April. Similarly, in April, 60% of sales is on cash. That means 60% of total sales will be collected immediately, and another 40% will be collected in the next accounting period. So let's see, in April, the total budgeted sales is 40%, 50%, 50%. 60% of 50%, 50,000 is 30,000, which is on cash. That will be collected immediately. And the rest of 50,000, that is 20,000, will be collected in the next month. And similarly, May, same thing. June, same thing. July, same thing. Well, in July, the sales on account, that is this part, will be collected in the next accounting period, that is August. Well, here, let's assume that bad debt is insignificant. Okay, in other words, we do not consider the case of bad debts. Let's assume all of the accounts receivable will be received. Okay, after the sales budget, we next need to prepare the inventory purchases and the cost of goods sold budget. This budget determines cost of goods sold for the budgeted income statement, ending merchandising inventory for the budgeted balance sheet, and merchandising inventory purchases in cash budget. Beginning merchandise inventory is known for the last month balance sheet. Budgeted cost of goods sold average 70% of sales. Desired in the inventory should be equal to 20,000 plus 80% of the next month cost of goods sold. That means This company has a rule for ending merchandising inventory at least $20,000. This is the fixed part, plus 80% of the next month's cost of goods sold. To prepare the inventory purchase and cost of goods sold budgets, we need to calculate the amount of inventory that needs to be purchased. To do this, we begin with the equation for cost of goods sold. Then we can rearrange the equation to isolate purchases on the left side. Well, basically speaking, this equation is the basic structure for inventory, purchases, and COGS budget. Well, let's take a look on the next slide. Okay, this is the budget for inventory, purchases, and COGS. How much inventory does this company need to be purchased? So let's take this month, April, for example. Let's take a look. For April, let's start with COGS. Well, the predetermined rate of COGS is 70% times the budgeted sales month. And in the previous slide, in the sales budget, there is a budgeted sales month for April. That is 50,000. Well, so here, 7% times 50,000 is 35,000, which is the COGS, budgeted COGS for April. Okay, next, COGS plus desired ending merchandising inventory. Okay, the predetermined rate for ending merchandising inventory is defined as $20,000 plus 80% times COGS for the next month. Well, COGS for the next month can be found right here. COGS for the next month is 56,000. Well, this number is also 70% of budgeted sales in May. Okay, for April, we know all of these three elements. One is $20,000, which is the basic, plus the rate, which is 80% times COGS for the next month. That is how you get 64,800. Okay, COGS plus desired ending inventory equals total merchandise inventory required. total merchandising inventory minus beginning merchandise inventory, we get budgeted purchase. Okay, let's see this question. Where do I get 35 for the month of April? Well, he's asking this number, right? This number is 70% times budgeted sales. That is 50,000 times 70%. Well, you may ask, where do I find $50,000, right? Well, this amount can be found right here. Right here. This is the budgeted total sales for April. So this number times 70% is $35,000. All right. Good question. Oh, well, I should have mentioned that if you have the textbook with you right now, you can look at, different budgets from the textbook. Well, if I use the PPT slides, I can show only one budget to you. But if you have the textbooks with you right now, you can refer to your textbook so that you can see different budgets at the same time. Well, let's continue. Okay, this is a inventory purchases and COGS budget for merchandising company. And I just showed you how do we get different numbers in April. Similarly, we can get these numbers in May, June, and July. Okay. Let's take a look at the numbers in May. Well, we have COGS, that is 70% times budgeted sales in May. We get 56,000 plus desired ending merchandise inventory, that is 80% of COGS of next month. Here, next month is June. We get total merchandising inventory required less beginning merchandising inventory. Well, beginning merchandising inventory. This number can be found from here. That is the ending inventory in April. Finally, we get budgeted purchases. Well, next, I'm gonna randomly invite somebody to explain the numbers in June. So let's see. Let's see who are online. Okay, why don't we invite John Attenbury to explain the numbers in June? So now you can speak. I can hear you. I have unlocked the microphone for you. Are you speaking?
Yes.
Oh, okay. Yes, good. So can you explain the numbers in June?
42,000?
Yes. All of the numbers in June.
Okay, so the 42,000, you get that number from the sales, well, from the last slide,
Yes.
that number, and then you multiply by 70%.
Wait. Wait. Let me show. Right here.
Yeah, so 60,000
Mm,
times 70%.
yeah, times 70%. Good. Next. How about 48,000?
So it's 80% times the cost of goods sold for the month of July.
Do you mean this number?
Yes.
Right, correct.
And then you add 20,000, right?
Yes. Plus 20,000.
And then when you add the 42,000 and the 48,000,
Mm,
you get the total merchandise inventory required.
yes. That is 90,000, right?
Mhm.
Yes.
And then you subtract the beginning merchandise inventory, which is from last, is the last month, 53,600.
Yes. 56,600 can be found from the last month ending inventory, right?
And then, you subtract that from the 90,000 and then you get the budgeted
Budgeted
purchase.
purchase. Good. Okay, thank you. Now I'm gonna mute you. Well, thank you. Very good. This is the inventory purchases and cost of goods sold budgets for merchandising company. Well, in addition to that budget, we still have the selling and administrative expense budget. Okay, please remember that the operational budget listed here. Operational budgets not only this one, but also this one and some budgets in the next slides. All of them are based on accrual basis. All of them are based on accrual basis. I believe everybody understands what accrual basis is, right? That means here the expenses incurred in this month, but the actual payments can be incurred in the next month. So the reason why I mentioned this is later we will look at the cash budgets based on this slide. Well, let's take a look at this budget, selling and administrative expense budget. The monthly payroll for the company is salary, basic salary of 2,500 plus sales commission equal to 15% of sales. That is a mixed cost with both fixed and variable part. The fixed part is here, and the variable part is the commission expense, which is 15% of sales. Well, for the sales, where can you find this number? Again, as I said, the sales budget is the cornerstone of the master budget. So the sales amounts can be found right here. The slides showed previously. Well, and another part of variable expense is the miscellaneous expense. That is 5% of total sales. In addition to them, the monthly expense are as follows. We have fixed cost, rent expense, which is 2,000, depreciation is 500, insurance is 200. So all of them are fixed cost. Here, I should mention that the depreciation expense is a fixed part. Do you remember 3 methods of depreciation learned in your financial accounting class? Right. The fixed method of depreciation is used right here. That means regardless of fixed assets usage, the depreciation for each month is fixed. In this case, that amount is $500 for each month, regardless of the use of fixed assets. So, for each month, total fixed expenses is 5,200, and the variable expenses is dependent on the total budgeted sales based on the sales budget. Well, in other words, that is 20% of budgeted sales. So this is pretty straightforward, I believe, right? So let's continue. Next part, the preparation of financial budgets for a merchandising company. Same thing, 4 parts of financial budgets. in merchandising company. This is exactly the same to the case in manufacturing company, including capital expenditures budgets, cash budgets, and an income statement and balance sheet. So let's start with the budgeted cash receipts from customers. The primary source of cash is from customers. The sales budget illustrated previously shows the total sales for the period. And I just said that the operational budget is prepared based on accrual basis. But here, cash statements should be prepared based on cash basis. Recall that the company's sales are 60% cash and 40% on credit. So that means 60% of the total sales will be collected immediately within this month, and 40% will be collected in the following month. So let's take a look at the case in April. All right. This number 16,000 should be 40% of the previous month. Well, this number is calculated as 14,000 times 40%. Well, you may ask, where do we find 40%, 40,000? Let's go back. Well, I just showed you here. The total sales in March is $40,000. And here I just listed that 40% of the sales in March will be collected in April. So here in the next slide, cash receipt budget, this amount 16,000 is collected as cash in the following month, that is April. Well, and here 30,000 is 60% of this month's sales, cash sales. So this month's total sale is $50,000 times 60%, right? Okay. 30,000 plus 16,000. That is the total cash receipts. 46,000. And similarly, for May, cash sales, that is 60% of the budgeted sales in May, plus credit sales from the previous month, that is $50,000 times 40% equals $20,000. That is, in total, $68,000. Well, this is the cash receipt. So here, let's assume the only cash receipt, the only source of cash receipts is from customers' sales. Okay, next, cash payment. Budgeted cash payment for purchases. Regarding cash payment, there are two outflows. One outflow is for purchase. Purchase of merchandising inventory. And another outflow is here, selling and administrative expense. Expenses. So first of all, let's take a look at the purchases. And let's assume here 50% of the purchase is paid on this month, and another half of the purchases will be paid in the next month. So from the balance sheet of March, we know that the total accounts payable is this amount. Let's go back. Total accounts payable, this amount. So let's carry this amount to here. To here. That means the cash payable in March will be paid in cash in April. Well, for the next number, 25% 900. This is half of April's purchases. Well, I'm gonna ask you, where do you find this month's purchase? Right, from the operational budget. That is the purchases budget. Okay, half of April's budgeted purchase is this amount. So 50% of last month's purchase plus 50% of this month's purchase equals to the cash outflow in April. And similarly, in May, same thing. Let's see. Half of the purchase in April is carried here. Plus half of this month's purchase. That is 22,400. We get the total cash payment for each month, for May, June, and July. Well, let's see another outflow of cash. That is the payment for selling and administrative expenses. Well, I believe you can remember that I just mentioned in the previous slide, that is selling and administrative expense budget. I said this budget is prepared based on accurate basis. So the cash payments budget, which is shown right here, is prepared based on cash basis. Because this is the budget of cash flow. It shows the income and outcome of cash source. So let's take a look. Use the previous selling and administrative expenses budget. We compute the cash payments for selling and administrative expenses. This company pay half of the salaries and commissions in the month incurred and half in the following month. Therefore, at the end of each month, this company reports salary and commissions payable equal to half of the month payroll. So 4,250 balance can be found in salary and commissions payable in March 31st balance sheet. That is half of the March payroll of 8,500. Well, I mean this number. Well, let's take a look. This budget is prepared into two parts, variable and fixed. For fixed parts, I think that's straightforward. And for variable parts, we pay half of this month's commission expense and another half of last month's commission expenses plus total of the miscellaneous expenses. So this amount is 100%. Well, I believe this is a straightforward part. Any questions? You can type in your question in the chat box. Well, let's continue. Short-term financing. Let's assume this company requires a minimum cash balance of 10,000 at the end of each month. The store can borrow the cash in 1,000 increments at an annual interest rate of 12%. And management borrows no more than the amount needed to maintain 10,000 minimum requirements. Total interest expense will vary as the amount of borrowing varies from month to month. Notes payable require 1,000 installment payments of principal per month, plus the interest of each month, each unpaid principal balance. This is an installment loan, so the payments of principal are 1,000 per month, even if there is additional excess cash on hand. Borrowing and all principals and interest payments occurred at the end of the month. So let's take a look of the cash budget for April. We start from the cash balance, beginning cash balance, plus cash receipts. Well, this number, 46,000, can be found from cash receipts budget. We get total cash available. And we subtract payment from total cash available. Total cash payments number, this number, can be found from the previous cash payment budget. Total cash available less cash payment, we get ending cash balance before financing. Well, for April, the result is ending cash balance before financing is only 2,950, which is less than the minimum cash balance desired. Again, the minimum cash balance desired is $10,000. So the difference is minus $7,050. But don't forget that for For the cash loan, the increment is $1,000. Therefore, in April, you need to borrow at least $8,000. $8,000 should be borrowed in April. With the financing of cash, that is a plus of 8,000. A plus of $8,000 minus principal repayments, which is $0. $0 in April. We get ending cash balance $10,000, 950. Well, this amount should be carried as the beginning balance for next accounting period. The beginning cash balance plus cash receipt minus cash payable is total cash payment. Is total cash balance before financing. Well, in May, let's see. This amount, the ending cash balance before financing, is greater than minimum cash balance desired, which is $10,000. Well, the projected cash excess is positive. That means we do not have to borrow extra money from bank in May. But we borrowed some money in the previous month. So starting from May, we have to pay back the principals. As I said, this installment is paid in each month for $1,000 plus the interest. Okay, let's see. The interest in May is $80. How do we get this $80? Well, to calculate the interest, we need to know the remaining principal. For May, the remaining principals is $8,000. Principals times interest rate. I said the annual interest rate is 12%. To calculate the monthly interest rate from from annual interest rates, we have to times 1 to 12. This is how we get $80. And same thing. For June, $70 is calculated as $7,000 times the interest rate, the monthly interest rate. Because in June, the remaining principal is 80,000 minus the payment, the repayments in May, 1,000. That is 7,000. 7,000 times monthly interest rate, 1%. This is how we get $70. So the interest expense in May is $80. Okay, this is cash receipts and cash payments as well as short-term financing budget for this company. Next part is the budgeted income statement. And I believe this is pretty much straightforward. All these numbers can be found from the previous budgets. Sales revenue, COGS, selling and the administrative expenses can be found in previous budgets. We have sales revenue plus COGS equals gross profit. Gross profit minus total selling and administrative expenses, we get operating income. Operating income minus interest expense, we get net income. Well, this is income statement budget. Next, let's take a look at the balance sheet budget. Well, all these necessary items can be found previously, including cash, accounts receivable, merchandising inventory, prepaid insurance, equipment and fixtures, accumulated depreciation, accounts payable, salaries and commissions payable, notes payable, common stock, and retained earnings. Okay, all these numbers can be found from the previous budgets, which is also pretty much straightforward. Okay, the last topic of this chapter: how information technology can be used in the budgeting process. Budgets require companies to complete many calculations, and information technology can make it more cost-effective for managers. primary two parts of making the budget is, first of all, to conduct sensitivity analysis, and second, to combine individual units' budgets to create the company-wide master budget. First, let's take a look at sensitivity analysis. The master budget models the company's planned activities. Top management pays special attention to ensure that the results of the budgeted income statements and the budgeted balance sheet support key strategies. Actual results often differ from plans. Management, therefore, wants to know how budgeted income and cash flow would change if key assumptions turns out to be incorrect. We previously defined sensitivity analysis as a what if technology that asks what a result will be if a predicted amount is not achieved or an underlying assumption changes. For example, what if the stock market crashes? How will this affect the company's sales? Will it have to be postponed a plant expansion, etc., etc.? Many companies use computer spreadsheets to prepare the master budget and the statements. Today, what if budget questions are easily answered within the spreadsheets programs, such as the Excel. Nowadays, many companies use Excel to make the budget and use the computer program to compare the actual performance, the difference between actual performance and the budget. Technology makes it more cost effective to perform more comprehensive sensitivity analysis. Armed with a better understanding of how managers in sales and costs are likely to affect the company's bottom line, today's manager can react quickly if key assumptions underlying the master budget turn out to be wrong. And next, let's take a look at the budgeting software. Companies with multiple business segments must combine the budget data from each of the segments to prepare the company-wide budgeted income statement and budgeted balance sheet. This process can be difficult for companies whose business segments use different spreadsheets to prepare the budget. Companies often turn to budget management software to solve this problem, often designed as a component of the company's ERP system. This software helps managers to develop and analyze the budget. Software also allows managers to conduct sensitivity analysis on their own segments data. So whether at headquarters or on the road. Top executives can log into the budget system through the internet to conduct their own sensitivity analysis on individual business segments budgets or on the company-wide budget. The result is that managers spend less time compiling and summarizing data and more time analyzing and making decisions that ensure the budget leads the company to achieve the strategic goals. All right, this is the end of this class. And thank you everybody for your attention. If you have any more questions, you can use the chat window to talk with me. Otherwise, I will see you next week, next Monday. Thank you, everybody. Oh, thank you. Oh, well, the quiz is on April 6th. Let's see, April 6th. April 6th is April 6th is a Monday. Well, there is no class on April 6th. So that means you can start your assignment right now. And this assignment is due on the last minutes of April 6th. This assignment has been available on Blackboard site. That means you can start now. You have almost 2 weeks to finish your assignment and to upload them to Blackboard site. And it is due on April 6th. And also, April 6th class will not be conducted. How will the quiz be given? Well, you can see the announcement on Blackboard. There is no in-class quiz. Instead, you're required to prepare the cheat sheet for submission. Are we starting a new chapter on Monday? You mean the next Monday? Oh, yes. Oh, you mean the next Monday? Okay, yeah. Yes, we will start a new chapter on next Monday. That is chapter 23. But chapter 23 will not be covered in your assignment. Okay, you too. Have a good day. Thank you. Be safe. Be safe. Thank you. Bye bye.